Hi, I'm Peter Resnicek from ShadowTrader.net and welcome to your free options training video. In this video, I'm going to show you the basics of 4 different spreads that I utilize all the time in my personal trading and also with my followers in weekly options advisory. We're going to be looking at ratio spreads, broken wing butterflies, unbalanced butterflies, and risk reversals. But more importantly, in this video, I'm going to show you actual real-life examples where we were able to put on these spreads for 0 cost, sometimes even receiving a credit to do so, and then show you how they were unwound for profits soon after. Without further ado, let's get into it. Okay, so let's start with the first spread that I wanted to show you, and this one is called the ratio spread, one of my favorites and one that we use very often in the weekly options advisory. A ratio spread is essentially nothing more than buying an option and selling a larger number of options further away from the money. It's usually done in a ratio of 1/2, but it doesn't have to be. It can be any ratio you like. It can be 2/6 or 2/4. Or whatever you like. Any of these would be called a ratio spread. It's always a ratio spread if the options that are being sold are further away. If it's the other way around and you're going like this, -1 +2, that's called a back spread. Back spreads are a lot more difficult to make money with, and they really only should be used when you're very, very sure that a stock is going to have a really gigantic explosive move in one direction. But even then, it's a lot more difficult to make money from back spreads than it is from ratio spreads. Let's look at some examples here, just looking at an options chain of SPX to show you exactly how you could put on a ratio spread and where it would profit and what the whole point of it is. If we're looking at the chain here in SPX, first of all, we'll just check the chart. We know that SPX is trading about 36.25 here in this area. So we know that those options are at the money. And we're just going to use this very short-term expiry of 2 days away from the time that I'm recording the video. This video is being recorded a couple days prior to November 18th. As you can see, there's a little 2 here telling you that there's 2 days to expiry. So let's say that we wanted to put on a ratio spread on the call side, and we wanted to target the 3,700 area because we felt that the market may move to 3,700 in the next couple of days, but maybe not much further past 2,700. So we could easily put on a spread like this if we click Analyze Sell on our Thinkorswim platform, and we choose /ratio, which means back spread or ratio spread. There's only one choice in the dropdown. And notice that we're buying the 3690 call, and here we'll just push this out to 3,700. And we're selling 2 of the 3,700 calls, creating this spread here. And notice, as I said before, you're long 1 option and short 2 options. And notice that because of the structure, this actually trades for a credit. So you would actually be putting this on sell to open, because that's how you open a ratio spread. A lot of people get confused by that. You're always selling to open a ratio spread and then buying it to close it. You'd be selling to open it for a 55-cent credit. So now let's take a look at our chart and see how this would play out in a couple of days at 3690 to 3700. So if we go back to the charts, we know that here at 3690, we are long 1 option, and here at 3700, we are short 2 options, correct? So what'll happen if, for instance, the market just dribbles along this way and stays under 3690 in 2 days and never rallies to that point? Well, what will happen is that upon expiry, this will obviously be worthless. The 3690s will be worth 0, and the 3700s will be worth 0, and the entire 55-cent credit will be yours to keep. But now let's look at it another way. What would happen if the market rallied up to 3690, and let's say it got there right on that expiry of November 18th? Well, this would be pretty interesting, because if it was at 3690, the 3690 options would be at the money. Obviously, they wouldn't be trading as high as these because they're 2 days out, but they would have plenty of value at the money, and the 3700 would have a lot less value. So there's potential that the spread would actually expand, and what was initially put on for a credit could actually be taken off for another credit. This happens all the time in ratio spreads, and it's really exciting. Let me show you a real-life example from our weekly options advisory where we put on a ratio spread on the put side in Netflix. I'm going to show you this trade right here, which is number 474. Okay? Notice here, as I said earlier, we sold to open. 4 simply means units. All the trades are just done in units. So officially it's a 4 lot, but you can trade whatever size you like. But we keep it small for educational purposes. And notice that we opened a ratio spread with an expiry of November 13th. And in this case, it was on the put side. We purchased a 477.50 put, 1 unit, and we sold 2 units of a 460 put. So that means that in this trade, it was actually 4 by 8 because our initial size is 4. Since we sold 4 ratio spreads, that means that there were 4 units of long options at 477.50 and 4 units, or 8 units, excuse me, short options at 460. Let's take a quick look at the Netflix chart to get a better understanding of why we did such a trade. At the time that we put on the trade, Netflix was trading somewhere here. This is about the time that we put on the trade. And the idea was that Netflix seemed to have rallied on a decrease in volume and had a chance of moving lower. But my thesis was that if it moved lower, it wasn't going to go lower than 460 because I knew that this strong support was there. So the situation seemed very ripe for a ratio spread, and that's what we did. We bought the 477.50 puts 1 time, and we sold the 460 puts 2 times, and that created our 1 by 2. In our official example, it was a 4 by 8, but it works the same way as 1 by 2. It doesn't really matter. It's all the same. And the idea, again, was that we would move lower, but not go below 460. And obviously, the maximum value for the spread would have been had Netflix parked itself at 460 at the end of the week, thereby making the 477.50 puts worth $17.50 and the 460 puts worth 0. Now let's see how this played out in real life. The very next day, Netflix, as you can see, had a big drop lower. It was actually a Monday. The trade was put on a Friday, 11/6, and then Monday was 11/9. As you can see here on the chart, you notice how Netflix did this. It basically had this large move lower. Let's take a look at what happened to our spread at that time. Notice that the very next day, as Netflix moved lower, the spread now expanded to a $1.96 credit. It was initially put on for a 3-cent credit. So think about that for a second. It cost nothing to put on because of the structure, because we bought 477.50s 1 time and sold 460s 2 times. We actually received a 3-cent credit to put the trade on. The very next day, we were able to close half the position, buying back 2 units for a $1.96 credit. And why is that? Because very simply, on this large move down, an immense amount of premium went into the 477.50s, which now became in the money and had intrinsic value, whereas prior to putting on the trade, they only had extrinsic value. And yet the 460 puts still only had extrinsic value because they continued to be out of the money. So even though it was only over the weekend and it was very short term, we took the opportunity to close 2 units at a $1.96 credit. Later that day, we closed another unit for a $1.50 credit and then waited until the next day to see if the spread would expand more and ended up closing it, the last unit, at $2.70. So this is an amazing way to profit with short-term options if you know exactly what you're doing and where to put them on and why. Remember, the spread was placed for a 3-cent credit because of its structure and then was taken off for dollars of further credit, as you can see. All right, let's get into our second spread. This one is called the Broken Wing Butterfly. Also a phenomenal spread to have in your arsenal of trades and one that is extremely versatile. So if you recall from the first spread I showed you, which was the ratio spread, that was simply a structure where you bought one option and you sold two options further away, thus creating a credit or a structure that could be put on for even money. The broken wing butterfly is similar in that at its core, it has the ratio spread structure, but then it also adds a long call or put further out, creating what we call a BWB. If you understand butterflies, you know that a regular butterfly looks like this, meaning that there's an equal distance between the long strikes, which are the wings, and those short strikes in the middle here that are called the body. This is called a straight butterfly or regular butterfly, and it always trades for a debit. You can never purchase a butterfly for even money or a credit. If it's a straight butterfly, it will always trade for a debit. But the broken wing structure is a little more interesting in that it can act like a regular butterfly, but at the same time be put on for even money or a credit because of its structure. Notice that the long vertical here that you're buying has a certain width to it, but the vertical here that you're selling has a greater width to it. So this one is much larger and this one is much smaller, and that is what creates the structure of either putting it on for zero or sometimes even a credit. Now let's look at the options chain. We'll look at a real life example of how we would actually put this trade on the Thinkorswim platform. Let's first take a look actually at our SPX chart, and I'll clear this. And let's make an assumption that, for instance, we thought that this pullback here, just above the 3,500, it's at about 3,510, was safe for, they say, the next 4 trading days or so. SPX options are very, very interesting because they have expiries not just on every Friday, they have expiries on Mondays and Wednesdays as well. So let's look out 4 days to expiry here, and let's look at that 3,510 and see what it's trading for. We can see here the 3,510 is 370. So let's look at a structure that we could put on around that 3,510, and let's look at some different broken wing butterflies. Notice that if we look at the 3,515, 3,510, 3,505, it's pricing out at zero, but that's actually not true. You would never be able to buy this for zero because, as I just explained to you, it's a straight butterfly. But let's turn it into a broken wing and see how it trades. Notice that if you buy the 3515s and sell 2 of the 3510s, and then instead of buying the 3505, you buy the 3500 instead, that comes out to a 30-cent credit. So how could you trade this actually in real life? Well, very simply, if you bought that here and the market stayed above this level and never got below the low end of the broken wing butterfly, you would retain that 30-cent credit and keep it. And what's interesting about this spread, and why I believe it makes a whole lot of sense, is that if you think about it, the structure of it is a lot safer than just selling a vertical at 3510 and assuming that we're not going to go to 3510, because if you know a little bit about options, you've probably already deduced that not only would you keep a 30-cent credit, but this trade could actually make money if it went under 35.15 and maybe stopped at 35.10. If on this particular expiry period, the SPX happened to park itself at 35.10, well, the spread would be worth $5, which is pretty incredible because you didn't pay anything to put it on. You actually got a 30-cent credit. The market actually paid you to put it on and is now paying you again to take it off. Much like the real-life example I showed you earlier in Netflix, where we put on a spread for a 3-cent credit and then took it off for dollars. This can be done in stocks or in equity indexes, or however you like. It's all just about creating the right structure and finding out how these broken wing butterflies price out and understanding where your risk is and where your reward will be. Let's look at a real-life example of the BWB that we did recently, actually in SPX. And for that, we're going to go down to trade number 466 recently. And that's this one. okay? In this case, we bought a put broken wing butterfly on the SPX, 4 units again, which was a 32.30, 32.10, 30.35. And we received a 50-cent credit for that, okay? Notice that all of this was put on and taken off on the exact same day. The spread was then closed a little later for a 25-cent debit, retaining 25 cents, then for a 40-cent debit, and then the last one was closed for a $1.20 credit. These trades are all managed very, very actively in our weekly options advisory. So so anything may have been happening during the course of that day where I would be just trading this live and putting out these orders one by one. But what's fascinating about this, once again, is the expansion on the last unit that we were holding. Is that something was put on for a 50-cent credit, and then it was taken off for a $1.20 credit. So there were actually two credits there, which is pretty incredible. Okay, let's talk about the unbalanced butterfly. So you should notice by now that there's kind of a theme here where we're starting simpler and getting more complex as we're adding more legs to the spread. Unbalanced butterfly is simply a structure that looks like this. If you recall from earlier, a regular butterfly looks like this, +1, and the broken wing butterfly looks like this, where it's all the way out here. So you can imagine in looking at these, if you understand a little bit just about structure, you should know which one of these are going to trade more expensive and cheaper, right? This one here is a debit. This one is either 0 or a credit, or could be a debit depending on how wide it is. And this one can also be 0 or a credit. And notice that it differs from the other two in that here, it's a very aggressive type of spread, which you would use on a very short-term basis, where you're long one vertical, but you're actually short 2 verticals here, thus creating the structure when it's all put together of +1, -3, +2. And this is a spread that you would use in a very short-term situation, maybe 1 to 3 days out, in order to capture a move to a very specific area. Let's take a look at that on the options chain to see how that would actually look. Let's continue to use our SPX example, but here we're going to go back to the very short-term expiry, which is really where the unbalanced butterfly tends to shine. Let's just take a look at our options chain here on the upside. Let's look at this 3,700 level. We just say buy unbalanced butterfly. And notice that if we put on the structure of 36.95 to 3,700 to 37.05, we could get a 15-cent credit for a very short-term trade targeting that 3,700 area. Now, it's probably not going to be that easy to make money with only a $5 spread, but we can always push these out further and see how they price out. Notice that we could do it 36.90, 3,700, 37.10 for a 20-cent credit, excuse me. So depending on how you push these strikes out and where you put the longs and the shorts will all obviously depend on where the spread makes money or doesn't make money. And just like a regular butterfly or a broken wing butterfly, the profit zone is the same in between the long option and the first short option. So here you have a potential of $10 profit for a 20-cent credit. And once again, you've put this on for less than 0 cost, so the market has paid you to put it on, and yet you have a chance to turn it in to multiple dollars of profit upon taking it off. Let's look at a real-life example, once again, from Weekly Options Advisory that we did recently. For this one, we're going to go out to a trade on the SPX. We're going to scroll down here and take a look at this trade here on the SPX. Notice the dates, that it was all done on the same day, which totally makes sense because this is the type of trade that is done on very short duration, looking for that burn of that extrinsic option theta value from those shorts. And because of the structure of the 132, you're either putting it on for very cheap or putting it on for a credit. But let's take a look at how we effectuated this in real life. Notice here, the trade was put on for a 5-cent debit. And what was it? It was on the call side, and we bought the 34.05, and we sold 3 times at 34.20. So we know that there's a $15 maximum profit here. And we covered it with 2 of the 34.50s. And again, dealing in units, this is 4 units. So in reality, if you did the trade exactly as it was done here in the advisory, you would have been buying 4, selling 12, and then buying 8. In this particular structure at these strikes. And again, it was put on for a 5-cent debit. Then, throughout the course of the day, the unbalanced butterfly was sold off piece by piece. First, for a 55-cent credit. Then again, for another 55-cent credit. Then another unit for an 80-cent credit. And yet another unit for a 60-cent credit. So once again, putting on very, very cheap and selling for much larger as we go. Okay, let's finish up with risk reversal. This is also another spread type that we use all the time in our weekly options advisory. It's extremely versatile and there's lots of different ways to effectuate it. I use the definition of risk reversal very, very loosely. But in general, a risk reversal is any type of trade where you are buying an option on one side of the chain, so either a call or a put, and you are selling options on the other side of the chain, meaning, again, either a call or a put, so that the net of the two transactions can be as close to zero as possible so that you can have a directional bias on and not have to pay for it. So that means that the risk reversal can either be buying calls and selling puts, or it can be buying puts or selling calls, or if you want to get a little bit more esoteric with it, like we do in the weekly options advisory, you could, for instance, be buying a butterfly on one side of the chain, let's say a call butterfly, and selling single options, just naked puts by themselves, on the other side. So there's a lot of different ways you could look at it. You could buy call verticals on one side of the chain and sell put verticals. Conversely, you could buy put verticals and sell single calls to pay for them. Any of these put together can equal a risk reversal. All right, so let's look at a real life example using this QQQ chart. And again, from our weekly options advisory, these are actual trades that we actually did with real money and were actually put out in real time through our dedicated app, through push notifications to our subscribers. And I'm just going to mouse over these bars here. And I'm going to show you here this particular bar, which is November 4th. It's exactly this bar. And the reason that this bar is important in terms of setting up a bullish trade is that it is the first day that the market gaps up after a downtrend. So as I saw that happening, and I knew that this downtrend, or I should say longer term downtrend, was in place, I thought that once we broke this shorter term downtrend, we had good odds of moving to this longer term downtrend here. And so I wanted to set up a structure that was very cheap, but would also capture some of this move up to the trend line, where I thought that in a short period of time, we would move to the trend line, but not move too far past the trend line. So in order to do that, I set up a risk reversal with a long structure on the call side and a short structure on the put side. And let's take a look at exactly how that was done. It's trade number 470 right here in our blotter. And again, here are the dates that I talked about where I said we were looking at a trade on November 4th. And again, we purchased on the call side a 288, 292, 296 call butterfly. So again, thinking back to our earlier discussions of how butterflies work, where does this make profit? Perfect best case scenario would be to close at 292 on expiry, but it's not really necessary. I don't generally trade options in a binary manner like that. In fact, this is something that I teach constantly in the weekly options advisory, is that going for the home run is never the play. The play is very often to buy it for a nickel and sell it for 50 cents, or maybe sometimes even buy it for a 10-cent credit, as I've shown you is completely possible, and we do that all the time, and sell it for an 80-cent credit or a $1.50 credit. Going for that home run and expecting that your butterfly or your ratio spread or your unbalanced butterfly or whatever structure you have is going to expire at full value is really a fool's errand, and it's just not going to work. It's basically like playing roulette and just putting your money on one number and spinning the wheel and expecting that you're going to land on that one number. It could, and if it does land on that one number, the payoff will be huge, but the odds of landing on that one number are very, very small. So we don't trade that way in our weekly options advisor. We trade more with the mindset that spreads should be put on for a certain price and then should be allowed to expand for a greater price. So again, let's look at this example here. How did we structure that move that I just showed you on the chart? Well, we bought 2 units of a call butterfly on the QQQ for 77 cents each. Now, because this is a risk reversal, we needed to finance it on the put side. And how did we do that? We did that right here by selling 4 units of 271 puts. And if we go back to the chart, you're probably asking yourself, why the 271s? Why did we sell 271 puts at that juncture? Well, we know that this is our bar in question. Let's look at where 271 is on the chart. And lo and behold, 271 is all the way down here. So 271 is actually right at the low end. The low of this bar is actually 270.84. So it's actually right somewhere in here at the low end of the first candle that happened on a breakout. And this is also something that's very, very important that I teach all the time in this advisory, that options should never be sold just because they are far away, or just because they have a certain amount of credit, or just because their probability of expiring at 0 is a certain amount, or just because they have a certain amount of theta or delta, etc. All of that is probability-based trading. We don't do that. At Shadow Trader, we only trade technical analysis trading. So if we're going to be selling something, we're going to be selling it at an area that we know technically on the chart should not be violated. And if we're going to be buying something, like in this example, we're also targeting an area on the chart that's very, very specific, where we know that there is a technical turning point. Okay, so in this case, we're short these 271 puts, which we are short extra because we know we're short 4 units. And then we bought 2 of these butterflies. And now let's go back to the blotter and see how this trade worked out and how we did this in real time with our subscribers. Notice that here, going back to the trade, the 271 puts on November 4th were sold for a 36-cent credit. The next day, on the 5th, because QQQs moved up, which was exactly what we expected to happen, those puts got demolished and we were able to buy them back for just 2 cents, which is a 94% profit on the put sale. Now what happened to the call butterflies? We go out another day, and you've already seen from the chart that it moved up close to our target. And we sold 1 unit at $1.50 for double the cost, and another one at $1.54 for, again, double the cost. But it's actually much, much more than double the cost, because our cost was almost 0. As you can see here, the debit incurred for buying the butterflies was $154 on the 2 lot, and the credit received by selling the 271s was $144 minus the $8 that we paid to buy them back to close off the downside risk. So our initial debit outlay was very, very tiny, only pennies per spread. And then when we ended up selling one of them for $1.50 and another for $1.54, it's really all gravy at that point, and it's all profit. Thank you so much for watching and for your first step in taking your options game to the next level. Before I sign off, I do want to give you just a little bit of a disclaimer. These spreads are somewhat complex, and although I can make it look easy, it's not always so easy. I don't want newer traders just to take this information and run out into the markets tomorrow and try to find ratio spreads and unbalanced butterflies that are trading for zero cost or credits and just put them on willy-nilly. That's a recipe for disaster. There's a lot of different factors that come into play in order to make profitable trades like this. You have to know which strikes to choose, what's going on with the Greeks at the time, how much time there is to expiry, what's the technical situation of the underlying instrument at that very moment. It's a lot of nuance to unpack, so be careful out there. In my weekly options advisory, I do these types of trades and more all the time, and I hold your hand through them with all my subscribers through push notifications to your phone in real time. I charge only $49 a month for this. There's never a contract, and you can cancel anytime. Remember, these are very, very esoteric concepts that are not really taught by all that many people. And usually you would pay thousands of dollars to take courses to learn these types of spreads and how to use them, but you're really only going to be learning theory. With me, again, it's very different. You learn by doing. You receive trades in real time to your phone. I put them on, I take them off, and I'm always sending you notifications along the way as we're doing it, okay? In addition to that, we always have a private webinar every Thursday afternoon where subscribers can ask questions, and I'll send you my free market profile pre-market report called Peter's Pre-Market Perspective that'll give you all the key levels and scenarios for how that particular day is going to play out. Check out the link down below, shadowtrader.net/options to sign up, and once again, it's $49 a month, no contract, you can cancel at any time, and I hope to see you there.